I'm back, and this time I brought my crystal ball and my hard hat, so feel free to disagree with anything I'm saying. Take that which you understand and you feel to benefit you, and discard the rest. As you'll come to see watching this video, your mind is doing that for you anyway. We covered the supply side changes that the halving will bring to Bitcoin in the previous episode. This time we're going to look at the meaning and implication of event psychology, and then we're going to look at the TA to find some really good low risk, high reward entries for our trades. I'm not a financial advisor. This isn't financial advice. This is simply the nature of human existence and how I'll be trading the halving. Before we start, I'm Jamie. I'm in Bitcoin for life, so I don't care if I miss a price move. I know that there are plenty of opportunities coming my way as a trader. I use stop losses to limit my downside risk, and I don't believe in hype. I have zero interest in letting fear, greed, FOMO, or intuition affect the way I trade. I trade not to lose, but I also like a lot of chocolate on my biscuit. I've got nothing to sell you, this channel isn't monetized yet, and I make these videos mostly for fun and the hope of like-minded company down the road. If that sounds like something you like, subscribe, you and I will get along. Welcome to Tradespotting. This halving is the single most publicized event in the history of Bitcoin. We can probably agree then that it will be subject to event psychology. What is event psychology, Jamie? The term is often bandied about by people and even some professional traders who believe that it's as simple as buy the rumor, sell the news, but this is a gross oversimplification. It's actually a field of study in neuroscience and phenomenology that dates back as far as 1890 and the early Gestalt psychologists of the 20th century. It relates to how we organize our conscious existence. We don't experience our conscious existence as an endless stream, which of course it is, but instead as segmented events, each with a boundary at its beginning and end. Also, the low bitrate between our working memory and our long-term memory means that we can't process, never mind remember, every detail that we see, hear, smell and feel. So we chunk information using these event boundaries. This limitation is in fact an evolved mechanism that allows us to process those details we deem to be important. This allows us to guess at and plan for the future. It's how we survive. For example, I'll be hungry tomorrow, so I better get food in advance so that I can eat then, so that I don't starve, so that I don't die, etc. We only understand the present by leveraging our Gestalt impressions of how an event will end. At exactly the same time, we are anticipating the future based on a provisional perception of the present. These Gestalt impressions are placeholders in our mind, allowing us to establish a continual feedback loop, which is there for our survival. The end boundary of each segment in our experience is rarely reached when we anticipate it will be, but rather when our reality starts to differ from our expectations. At this point, our consciousness takes all of our information from our working memory and imprints the start and end in our long-term memory, discarding much of the middle. So now you understand a core tenet of psychology, that we as human beings can only understand our present by anticipating the future, even if that future never comes to pass. You also now know why it's easier to remember the start and the end of things than it is the middle. Our perceptions of event boundaries are often used against us. A quick analogy might be you're crossing the road and you're expecting to get to the other side not too long, but somebody revs an engine and beeps a horn, so you jump and you speed up a little bit, only to look over and see they're sitting behind the wheel, not moving, smiling at your reaction. Now that might be a crude example, but it's a helpful analogy that we can return to later. How does all this relate to trading, Jamie? Well, these event boundaries in traders' minds are manipulated to get them into position, to create liquidity, and to take all their capital off them. Right, so now you know why the human mind chunks information. This is referred to as event psychology, and more specifically, event segmentation theory. So if anybody ever mentions it to you in future, you can tell them a little bit more about it. Let's hold this idea of chunking in our mind and move on to the charts, where we'll look to see if the technical analysis has any suggestions for where we might find high reward but low risk trades. Here we are in the charts. We are looking at Bitstamp. It has price history which covers the halvings which have come before. You can see I've marked out the previous and upcoming halvings with these red serrated vertical lines. We're on the monthly timeline to start off with, just so that the macro trend is clear. I've highlighted this trend in lead up to each of the halvings using these channels. You'll also notice I have added an indicator below called the hash ribbons. It identifies points of minor capitulation, as we talked about in the previous episode, and also signals the best buying opportunities. You can find a great explainer for this indicator by the guy who made it in the description below. But to put it simply, hash ribbons identify points of minor capitulation and then flash a buy signal, but only when the hash rate has begun to recover. Now we're going to take a closer look at what happened around the halving dates. Here we are on the daily time frame. The macro trend is quite obviously bullish. For approximately a year, we were making higher highs and higher lows on the daily time frame. This is called an uptrend. Even those wicks that made it out of the channel we have drawn here were bullish. Downside risk is negligible, and trading during this period was easy breezy. In the week preceding the halving, the price was still moving up. Some people would tell you the event and the psychology associated with it started on the day of the halving itself. Some would say it started days or weeks beforehand. And yet others will tell you that it began here on November 2011. But the truth is, Bitcoin is still a toddler, and back then it was a baby. Hype about the halving was low compared to the publicity it gets today. This was of course due to the fact that not many people were mining it. You can see an indication of this on the hash ribbons below. Our hash rate was very low. I was working at an investment bank back then, and anybody I mentioned Bitcoin to looked at me like I had two heads. More fool them. The halving still led to a capitulation event though, despite the fact that the technology it was being done on by miners was very basic. The capitulation is marked here by the indicator, and that's very important to note. If there was a capitulation event when you could mine Bitcoin on your Tamagotchi, then what do you think is going to happen now with the progress in that industry? When did the event boundary come into play? That is to say, when did the price action suggest the psychology of the event had ended? Well, on the day of the halving itself, the 28th of November, nothing distinctly different from the preceding trend happened. Shortly afterwards there was a pullback though. If we measure it here, we can see it dropped on this chart by just over 10%, over the period of a week. I know from experience that on other exchanges it dropped upwards of 13%. If you take the high before the drop to be the end boundary of our event, you can see that the halving itself was only bullish. If you anticipated a rise after the halving date, then the fact that it went down would mark a change from your expectations, and you'd have to say that the event itself had ended psychologically and practically. When the retrace ended and the difficulty levels stopped falling, our indicators flashed a buy signal down here. This came at what ultimately was the macro low. The high before the next halving came in a year after the halving date, at which point we could see with our measurement tool the price had risen nearly 10,000% without making a lower low that whole time. What does this tell us? Well, the date of the halving was not a bullish day. The drop after the halving date gave us an ideal entry here, and that gives us a low risk, high reward trading opportunity, which was demarked and signaled to us by this flash on the indicator, had you had that at the time, which it wasn't invented until recently. So the takeaway for investors here is the trade spotting mantra. No help in rushing to be rich, and plenty of wealth in waiting to be right. Traders could easily have shorted the peak in and around the 28th, taken advantage of that 10% downward move, avoided being liquidated by waiting until the end boundary of the event before jumping in with their longs, and they would have made huge gains. They would have made a significant gain on the pullback alone. But it's still true to stick to the trade spotting mantra: there is no help in rushing to be rich and plenty of wealth in waiting to be right. The main point to remember from the first halving would be that only after the supposedly bullish supply side change was there an ideal low risk, high reward entry, and that took a whole year to subsequently play out, so there is no rush. Let's move on to halving number 2. El Segundo halving. There isn't much TA we could do on the first halving when we looked at it in isolation, but we can use it as a point of comparison now. There are similarities and differences to note. In the run-up to the date, the masses were salivating at the Pavlovian idea of a 10,000 percentage point rise. The beginning of the enthusiasm was clearly long in advance of the event itself. The event psychology was clearly in full swing. Bear this in mind for the upcoming halving. The price action had peaked 24 days before the date of the halving. We were in a bullish uptrend, but it peaked before the date. If ever there was a case for ignoring FOMO, this is it. In the days before the halving, many people saw this as an ascending triangle, which tends to break bullishly. They believed that supply side economics was in the favour of the bulls, and they put this together with their understanding of when the event boundary would come, and they got themselves wrecked. While price action recovered quickly after this, we didn't get a buy signal on our ribbon indicator until 3 weeks had passed. By which stage, anybody who'd gone long within the past 63 days was either underwater or they drowned. On the day of the halving itself, we printed a doji candle with wicks ranging 5% either side of the close. Plenty of people will have jumped in on one side or the other of this and also got themselves wrecked. The low risk entry was certainly after the event had ended. Traders and investors anticipated the event would play out as it had done previously. This created liquidity which large accounts then took advantage of to get extra capital for themselves. There wasn't an immediate sell the news event on the day of the halving itself, as we can see from the price action, but as we discussed in the previous video, the minor capitulation doesn't happen immediately, and our understanding of when an event will end is open to manipulation. What else can we take from the second halving? Well, if I turn on the moving averages, we can see the dump took us down below the 200 simple moving average, marked here in white. This is a perfectly healthy thing for any asset to do ahead of a large move upwards. We didn't get our buy signal on the hash ribbons until the 21, marked here in yellow, had crossed above the 55, which is here in green. As the price came back from its test of the 200, this would have marked an excellent entry for traders. The 200 is a sensible place to put a stop loss after a quick test, and this would have given you a trade with a very low risk. Of course, there's unlimited risk in markets, but that's why we use stop losses. If you'd like to know more about stop losses or moving averages, or indeed just how to get the best out of TradingView, check the other videos on my channel. Less aggressive traders, or perhaps investors, might have used this bullish cross of the yellow and green moving averages to enter. This trade would never have gone underwater, and the entrants there were able to ride this rise all the way up to 20,000, which is a percentage increase of over 4,000%. So the event psychology was not as simple as sell the news, but the halving did mark the start of a few bad weeks for Bitcoin. Overeager traders who got in before the halving date, anticipating this huge rise, would have been cursing their hastiness for the next couple of years. Remember, there is no help in rushing to be rich, and on this occasion, staggering wealth in waiting to be right. Let's move on to the upcoming halving and see what we have learned and if it applies potentially in future to help us create a balance of probabilities we can use to trade. We have done our homework on past price action through the halvings. We've tempered our enthusiasm to protect us from event psychology. But here we are, hours from the halving at the Bulan Darvasa, and things will never be the same again for miners. Many people, myself included, have our eyes open for long-term positional trades. We are aware of the fact that we might be starting a trend that will end in a new all-time high. Where that might be doesn't actually interest us yet. We are looking for low-risk, high-reward trades. Where do we find these low-risk, high-reward entries? Well, this reminds me of an old joke in Ireland. When somebody asks you for directions, you say, well, if you're going there, you don't want to be starting here. Of course, in that instance, you don't have a choice. But in trading, with all the potential offered up by the halving and the charts, it's up to you to choose where to begin. Where would I like to begin? Well, I don't want to enter here. If we go up, great, plenty of chance to get in on that trend. If we go down, even better. There's many places to manage our risk on the downside. We saw the test of the 200 simple moving average on the previous halving. Sobering endeavour that will help us greatly is to imagine there's no halving at all, and what does price action tell us in this case? Right now we are testing a long-term diagonal downward sloping resistance line it comes in at our most recent weekly highs of around 10,500. A shed load of traders will be looking at this number thinking it's the top, and I'm inclined to think that their bums will get quite squeaky over the next week. We have tested this line 4 times in the past, and in Bitcoin land, 5th time's a charm. We have a CME gap at 11,800 or so, and it would be oh so very Bitcoin to go up, fill this gap, then come crashing down and crush the hopes of everybody who got in at any time in the recent past. We have never seen Bitcoin bottom without it putting in divergence. And there's a lot of room below us, if we were to fall into it, where we could still make a higher low on the weekly timeline. Markets can do anything at any time, and this isn't financial advice. That being said, I have my eye on the 200 simple daily moving average. It's currently crawling in at around 8,200, but if we don't put in divergence when we make that low, then I'll be looking towards 7.8 and 6.8. I even hear my name being called around 3,500. If you want to know why, you'll have to tune in to the next video. If you can't wait that long, I suggest you search Rocky Outcrop on YouTube. In my opinion, there is nobody better at FOMO-free analysis, and he does daily videos on Bitcoin and others. Until then, good luck, stay safe. You have my best wishes in every trade. Subscribe for more of the same and click like for better. I'm Jamie, and this has been The Halving by Tradespotting.